This is the balance sheet. So this is part two of our accounting review, and this is the balance sheet of the same company. Remember last video we looked at the income statement, and you can go back and refer to that. But the thing about the balance sheet is it's the other important part of the financial statement. You have your income statement, and the income statement flows into the balance sheet. So basically, the income statement is what you earn that year, and the balance sheet is your statement of where you stand as a company at a particular point in time. So the balance sheet is designed again to balance. So debits and credits need to balance, and your trial balance when you put entries in. The debits and credits have to balance each other. So if I debit an expense, I also have to credit care. I might have to credit, debit an expense. I might have to credit, a corresponding entry in order to make sure that my books balance, and then the balance sheet needs to balance. So if I got a credit for equity, then I might also want to see a corresponding entry in my cash account because people bought equity in my company. So you see how they're always balancing each side of the balance sheet. Now, in a typical balance sheet, you start on the left side, which are the assets, and you go most liquid. So we start with the most liquid assets. So begin with cash, which is obviously the most liquid asset you could hold because it's fungible and you can turn it into just about anything. In other words, you can exchange it for anything. That's the idea of liquidity. You don't have to. Liquidity is cash definitionally. And in this particular company, they have this much cash on the books. And once again, as a reminder, you always want to compare your balance sheet and the health of your balance sheet to others in your industry. Some companies might require a large cash holding, some might require very little cash holding. But again, you have to kind of balance it against the companies in your industry. After that, we have marketable securities because that's pretty much a liquid. Those are liquid also. You can cash them in, you can sell them in the market. Accounts receivable is a little different. That's the money we lend to our customers to bring sales in. From time to time, we will offer terms to our customers. Lending, we will lend money to our customers. And accounts receivable represent the amount of loans on the book. Now, we expect that to become cash. In some cases, the auditor might do if an auditor comes in, they may look at it and say, well, they may take a haircut on it. We call it a haircut. They may say, we expect you based on past performance and the industry, that you're going to collect 95% of these receivables. So they may be a little more conservative in terms of the valuation. They're not going to count it as exactly cash. They may do the same thing with marketable securities because it isn't exactly cash. And obviously another, touchstone will be the inventories. From time to time, you might say, well, the inventories are cash related. It could be gold you're holding. Obviously, you could turn that. That's incredibly liquid. Or automobiles on a cost deal is that are pretty liquid. But then again, if you have perishable products or things that can kind of deteriorate, like clothing, that inventory has to be treated subject. So we'll learn later classes when we talk about ratios. We sometimes take out the inventory out of our current ratios because we know that the inventories could be subject to a lower valuation. So when you add these up, you get your current assets, and that's why I have it in yellow. And you'll notice I summed them up here. And then we get to the more illiquid assets, which is your land and building, your machinery and equipment, furnitures and fixtures, vehicles. These are things that are illiquid, capital goods, things that we use to make other things. And when we add the gross fixed assets at cost, at what it cost us, we're going to come up with that number. We sum it. And then you take away depreciation, which if you want to learn more about depreciation, please watch my video, my income statement video, where I really talk about depreciation. It's the amount the government allows us to write our assets down and deduct from our income. But so, and I'm going to do its own, at one point I'd like to do its own video to further explain depreciation. But basically it's the write down of assets that we've written our income down by a certain amount, and we get the tax benefit. Obviously, if we sell these assets, our new cost basis will be this minus the depreciation. Again, go through my income statement video. And that would be the net. When you net them out, you get a net fixed asset. So when you add these two numbers, 7 and 15, I'm going by this side panel, we're going to get 3597. And when we go to the liability side, you basically have the same thing. You have the most liquid liabilities, which is accounts payable, money we owe to our vendors. Usually you want to bounce off your receivables and your payables. That's money we lend, money we owe. Notes payable, which is short-term borrowings. Think of it in personally like a credit card. And accruals, which are things we owe that we've used but we haven't paid for yet. So you might have a liability on your books, like say insurance, but when you close, you haven't paid the insurance bill yet, and that's a liability to your company. So say you had like, employee insurance, unemployment insurance. You might be accruing this expense, but you don't have to pay, say, in February, but your books close in January, and you already have 4 months of this expense, but you would accrue that expense here. You can also accrue assets. I mean, if you prepaid an expense, you would accrue that. And again, another subject for another day would be depreciation and accruals. We will definitely look at depreciation and accruals in another video, but because those are important. And I want to make this as comprehensive as possible, and I don't want to give you too much in one video. So when we add these up, we get total current liabilities. Add on the long-term debt, and now you have, and long-term debt is basically your long-term borrowings, and now you have total liability. And remember our identity, which is assets equals liability equals assets equal liabilities plus equity. So there we have our liability, 1643, and now we look at our equity, our preferred stock, our common stock. That's what we had on the books when we sold the common stock. That's why we call paid in capital in excess of par. So we have the common stock that was like the par value of the stock we sold, and then we obviously, well, not obviously, but we received more money after par. People paid more for our stock than we actually had it on the books, because the par value of the stock is something you have to set in the beginning. So you might say we're going to call it a $10 par value, but when we actually sold the stock to the public, we might have gotten 20 or 25, or as we sell it, we get higher prices. So we're going to have to add that to excess of par. Again, it's just like an accounting construct. But to understand it again, we have to put a par value on our stock. So like, again, they might have said, well, this was a $10 stock, but as they were selling it in secondary offerings, or as they're selling it in additional offerings, they might have gotten higher prices, or they did get higher prices. So you mostly will see this on the books. And then we have our retained earnings, which are earnings from the previous year, which we're going to go over a retained earnings statement in the next video. So when we add these up, we're going to get total equity. And when we add liabilities and equity up, we get our total liability and stockholders' equity. And notice that they both balance. And that's why we call it a balance sheet. So assets plus liabilities assets minus liabilities have to equal equity. Liabilities plus equity have to equal assets. Assets minus equity have to equal liabilities. Once I know two of them, I can figure out the third. Again, assets minus liabilities equal equity. Equity and liabilities equal assets. Assets minus equity equal liabilities. Assets minus liabilities equal assets. Again, if you want a copy of this interactive interactive financial statements, please email me in the comments, or contact me through the comments, and I will send them to you. But I appreciate you watching, and hopefully this continues to help. And this is part 2 of our accounting overview.